Okay, let's finish up the financial statements. We're going to, in this lesson, go over the income statement and the cash flow statement. We finished last time with the balance sheet and learned you've got assets minus liabilities equals owner's equity, or assets equals liability plus owner equity. And we also learned that this is a snapshot in time. You pick a time, and it's usually the end of the year and the end of each quarter that you present this, and it just gives you what your balance sheet looks like at that particular time. It may change completely the next day. You don't know that. Now we're going to talk about the other two and start talking a little bit more about how they're interwoven. So the income statement is the next one, and this is what you would think of as your profit and loss statement. Ooh, we've got a rogue arrow down here. Oh well. So the income statement consists of revenue and sales, call it either one, it's the same, minus expenses, and there's all sorts of expenses. That equals your profit or loss. Okay, that's not a big complicated thing. However, when you take a look at what's in all of these, it can get a little more complicated. So revenue and sales may include discounts on the particular line that they show them, or you may see a discount below them subtracting from revenue and sales. A lot of companies will just report net revenue or net sales, something like that. But whatever the very top first line is, you'll get revenue and sales. There may also be from different types of product lines. It depends upon how they break their things down. And then for the expenses, they usually go into two main categories. One is cost of sales or cost of goods sold, and the other is the other expenses. And a lot of times after the cost of sales, they will report something called gross margin. So as I said, the revenue and sales could be broken down by product and services. So for example, if you look at Apple, I know for a fact they have two revenue or sales lines. One is for product, one for services. Not all companies are like that, but those that are would break them out. And then the other expenses can also be broken down further, and they're usually reported as sales and marketing, research and development, and then the catch-all general and administrative. So that's where all the as I used to call them when I was below that level, I used to call those overhead. So this is the basics of your financial, the income statement. And basically it's just sales minus expenses equals your profit or loss. And obviously you want to make money. Okay, so the elements of the income statement. Whatever the top line is, it may or may not be net, but it has to include all sources of revenue from operations. If you make money from non-operating stuff, we'll talk about that later down at the bottom. But up top, it's whatever sources include all your sources, revenue and sales. By the way, as an aside, in the financial statements, companies are obligated to break down sales by major product groups and by geographic area. So US or North America, Europe, Latin America, Asia, and stuff like that. So you can see how dependent companies are on a single product or product line in a geographic area. There are usually several expense lines, but obviously, almost always the very first one is some sort of thing called cost of sales or cost of goods sold or cost of products or something like that. And then usually they break down how much they're spending on research and development, sales and marketing, and then general and administrative, as we talked about. This includes all costs. So for example, if you have a change in inventory, so in your budgeting exercise that you filled out, the little bitty guy, if you were selling goods, you had to have a beginning inventory and an ending inventory. Well, there's a change in inventory. You had to spend money increasing the inventory, or if you reduced it, that was a good thing for your income statement. It also includes things like depreciation. If you recall, we talked about this. When you buy a big capital asset, you don't expense it all into your profit and loss statement in 1 year. You do a little bit every year for the number of years that the asset is going to last. And that's called depreciation. So it's the gradual decline in the value. So you put a depreciation amount in your profit and loss statement as an expense. But let's think about it. Did you actually spend any money on that? No. you spent all the money buying it, right, initially, but now it's on your balance sheet, and you're going to take a little, carve out a little bit of it and put it into your P&L, and therefore your balance sheet, your property, plant, and equipment account has to decrease. And then usually these things show, as I said, the gross margin, which is just the profit after you take away cost of goods sold. We talked about that when we talked about gross margins. Earlier, profit margins, we talked about how a pharmaceutical company has really high gross margins, and somebody like a Safeway would have much lower gross margins. And then you'll have something called operating income, which will be after all of the expenses like R&D, sales, and marketing. Then you'll get a group of income and of expenses that are called non-operating. And these are things that don't have anything to do with your business per se, but have to do with things like, are you making interest on your investments? So you get income from that. You have to declare that or state it in there. Or maybe you're paying interest on something and the taxes that you have to pay. Anyway, that stuff all gets laid out kind of below, so as they say, below the line, below the operating line. Okay, here's an income statement for the exact same period of time for SNAP as we showed on the balance sheet. Now, first of all, what you'll notice is this covers a period of time. So it covers the 3 months ending, and they show 3 months ending 2018, 3 months ending 2019, so you can compare that quarter. And it also compares year to date, so 9 months ending September 30th, 2018 and 2019. So you can see how their sales are growing and all their expenses are growing and everything else. Okay, over here, I've got this title of revenue, and I got an arrow to it. That's their net sales. So they don't have any discounts or anything below that. So that is their net sales. Then you have costs and expenses. The first one is the cost of revenue. So they're not making a product per se, but they have a bunch of engineers and other people working directly to keep their platform up and running. All that is included in their cost of sales. Then you look below there, they have research and development, sales and marketing, and general and administrative. So they got a bunch of engineers looking at new platforms, new features, and all that. They don't put that into their cost of revenue because they're working on future products, and some of which may never see the light of day. Then you have the sales and marketing of 123 million, and then G&A of 117. Now, kind of interesting, if you look at this, they're spending as much on R&D basically as it costs them to generate $450 million in revenue. So they sum all those up, total costs and expenses, 675 million, revenue of 446 million. Oops, they're making a negative amount of money. So they've got an operating loss of 223 million, but then they've got interest income. If you recall, somebody better get that phone. If you recall, they had a bunch of money that they have started to amass, and they're making interest on it. So they have to report that into their interest income. And then they also have some interest expenses, and then they have other income expense. So they have a total of 228 million of total expense that they've got to add into their statement. And then the total net loss you see down there is 227. Now, interestingly, if you take a look at their income tax bill, that's a benefit. In other words, they got income tax credit. They not only didn't pay, they got an income tax credit. Okay, the last thing to note here is, again, this covers a period of time. So if the balance sheet is like a snapshot, this is like a movie over whatever the period of time is. So this shows you what they did over a period of time. The balance sheet just takes a look at it. Okay, the last one I want to talk about is the cash flow statement. Another rogue arrow. The book doesn't talk about this, so this is going to be your only source of information on this. So this is also a very important statement because, especially in the early days of company before you get profitable, you don't want to run out of money. So, for example, Snapchat is losing money. And so I would want to make sure that I had a look at their cash flow statement to see how long can they continue to do what they're doing without running out of money. because if they run out of money, they're going to have to get additional source of financing. So you take the beginning of their cash balance and you subtract whatever they use, plus then you add whatever sources they have of getting new cash. And it may be from investors or they sell bonds or whatever. And then you find out what their ending cash balance is. So you're looking at cash. So basically, cash at the start, plus you make money or lose money from operations cash flow, plus investing, plus or minus financing. These are all plus or minuses, by the way, because if you're losing money, they'll be negative. You only consider cash, and this has to reflect changes in the balance sheet. Now, this is where it gets a little tricky, but when you think about it, if I've got accounts receivable, which means somebody owes me money, if those increase in value, people owe me more money at the end of a period than they did at the beginning, that takes cash, right? And so that then has to be reflected in your cash flow statement. So beginning minus uses plus sources equals your ending balance. Again, let's take a picture of the cash flow statement for SNAP. Again, first of all, notice this covers a period, and as it turns out, lo and behold, it's the exact same period. These statements all are, as it was for the income statement. So 3 months ending September 30th for 2018 and 2019, and the 9 months ending also 2018, 2019. Now, this is a couple of pages long, so I only took a snapshot here, a screenshot of the top part of it. So let me just take you through this. And the first thing is they start with operations, cash flow from operating activities, net loss. Okay, that's your net income. That's the very first thing you start with. So if you recall, they lost $227 million for the quarter ending September 30th, 2019. That's your starting point. Okay, then they add 20.6 million of depreciation and amortization. If you recall, it had to go in their P&L statement, so that 227 million loss included 20 million of depreciation. But that's not a cash flow, so I'm going to add it back. And then there's stock-based compensation. This is another nuanced thing, but any employee that gets options there, that is a stock-based compensation. You have to expense it, but it doesn't cost them a penny in cash. And then you see the other stuff they have down there. And then changes in operating assets and liabilities net of effective acquisitions. So this gets back to your balance sheet changes that I talked about. So accounts receivable, they used $62 million in cash by they had to increase their accounts receivable. So that's money they don't get. They have to fund that, so to speak. That doesn't show up in your P&L, but it is a cash flow. And then you see the other stuff. Now, by the way, accounts payable, you'll see is a positive number. If you increase your accounts payable, that means that, you're not paying out that, so you get credit for that on the cash flow statement. So again, this covers a period. It is a critical element of every company's financial statements, and it's something that people look at very closely, especially even big companies, somebody like a Tesla who was burning through cash like crazy. And they had billions of cash, but they were burning billions. And the question was, are they ever going to get profitable before they completely run out of money? Well, as it turns out, they made it. Okay, so we're going to stop there, and we'll finish chapter 12 with payroll and a couple of other things. But for now, you guys are kind of all good to go on the balance sheet, income statement, and cash flow.